Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, I'll ask that you hit thumbs up and subscribe. Questions, comments, put those below. As always, I'll start off a little bit here on what I'm reading, what I'm studying. I just finished a book called Fed Up by Danielle DiMartino Booth. She spent 10 years in the U.S. Federal Reserve as a research analyst. And I actually subscribe to her daily newsletter, which is basically economic research, leading indicators, etc. So the whole book premise is basically on how the Federal Reserve acts and thinks, with the main premise being that she believes they're actually a lot of the times in the rearview mirror, very focused on their PhD models, and sometimes unwilling to step outside of those models and actually get a grasp of what's happening in the real world, on Main Street, so to speak. And so, she actually talks about how there was a lot of these PhD guys and people in the Fed, you might have think they would have a close eye on financial markets, but actually a lot of them didn't really give two shits about the financial markets, which is actually kind of fascinating when you think about it, and the people that are controlling the money supply. To add to that, last bit of housekeeping before we dive in is there was also the Macro Voices live event here in Vancouver this past weekend. That was a podcast. They run a weekly podcast I've talked about in these videos all the time. Some great speakers there. My favorite being Julian Brigden of MI2 Partners, macro research investment firm. So he gave a good speech up there. I think the premise of his speech was, and I tend to agree with him. Anyways, he believes that you're kind of in this deflationary trend right now, particularly with the Federal Reserve reducing their balance sheet at $50 billion per month. But he believes, the timing is hard to get, but in the next 4 to 5 years, etc., the only way out of this sort of debt trap and all these pension liabilities, etc., is to inflate your way out. So you're going to have to basically devalue the currency, inflate your way out. Obviously, that would impact people saving, old people on their pensions. It would basically erode the real value of that. So I think that was just and that was kind of the consensus, to be honest, at that speech with all the speakers. But Julian actually did a draw. Put your name in the bucket for a 1-year annual subscription to his service, MI2 Partners. And lo and behold, the winner right here. So very excited about that. Apparently it's valued at a $36,000 annual subscription that goes out to institutional investors around the world. So hopefully I can disseminate some of that information into these videos and pass along some of that research, some of the stuff, insights from that into these videos. So very, very excited about that. But yeah, without further ado, we'll get back into the Canadian space, particularly in Vancouver. The things that I'm looking for, the things that I've been watching this week. The pre-sale space, as I've talked about, is I think highly prone to the slowdown. As I've talked about in multiple videos, this is a market that was predicated on rising prices and a lot of liquidity. And so what we're seeing now as the market moves sideways and prices trend lower is these assignments, these people that are flipping contracts are becoming extremely illiquid. They're very, very, very difficult to get out of. People, when they have options to choose from, buyers are very picky right now. They're not interested in a piece of paper that's on an unfinished condo unit that they can't even walk through or even go through the old presentation center. So these are becoming very illiquid contracts, and they have a very substantial foreign influence. You can see for official CMHC data, shows condos aged between 2016 to 2017, 15% of people in these buildings are foreigners, and that's much higher than the 5% number in older buildings. So what we're seeing is just some of the insights that are coming out now in the data. MLA Canada recently wrote a report, and they work closely with the developers. is they studied the buyers, the end users in Burnaby. So they said anyone that bought like high-rise concrete condos in Burnaby. They've been taking this poll basically since 2010 into 2018, and what they were able to say, they asked people, they said, is this for an end use purpose, i.e. are you going to live in it, are you buying to live in it, or is this an investment? Are you buying this to rent out or to flip down the road? And what they show in their figures is from 2010 to 2012, that number was something like 85% end users. And then from 2014 to 2016, end users dropped off to about 50% or something along those lines. And then more recently, from 2016 to 2018, end users now only make up, I believe it was it 37% are end users. No, it was 33% end users. So basically, long story short, is they found that people purchasing in Burnaby pre-sale condos, 67% of them were not end users. They were people that were purchasing as an investment. And again, these cash flows, these condos at these prices do not cash flow. Period. End of story. And they're becoming much more difficult to flip. So this is a very interesting dynamic that's playing out. And of course, you're seeing the market being flooded with assignments. A lot of them can't even be marketed on the MLS. So you kind of have a hidden inventory supply that's kind of lingering on Craigslist, WeChat, Facebook groups. A lot of people trying to get out of these pre-sale contracts that cannot get out. So that'll be very interesting to see if the market continues to move sideways, how this pans out. How do people get financing for these pre-sales that they overpaid for, etc. So it's something I'm watching for. The other thing that I wanted to dive into, it's kind of a topic of this week, you're seeing as the federal election ramps up here into 2019, a lot to do with housing. It's still the main topic, the main friction point amongst society is unaffordable housing. And what you're seeing is strong pushback from the industry, the people with the most to lose when Canadian national home sales fall to a 6-year low. And the average sales price drops, 4% the first time doing it in a decade. You're getting a lot of pushback, not only from the National Home Builders Association, but the Canadian Mortgage Professionals Association, going on the media and saying the stress tests need to be repealed. You had Bill Morneau talking about how they might look at maybe doing something for millennials or helping them out in some way. But then you also had a report, a leak from Thomson Reuters today, saying that policymakers are now looking at potentially introducing a stress test on private lenders. So it's like, how do we understand this whole situation? How does this shape up? How does this play out? What are the implications? So first and foremost, the main issue that I have with these companies, these Mortgage Professionals Canada guy was going on BNN the other day saying, this is really hurting the poor millennials. They can't get into the housing market, and is pushing the low end up. It's really hurting the millennials. Canadians need access to credit, and the stress test should be reduced from 2% to 0.75%. And part of his thesis for that was, in the next 5 years, they said, in the next 5 years, wages will rise about 10%, thus offsetting the rise in interest payments. But it totally miscalculated that if wages are rising 2% per year and inflation is running on average at 2% per year, that is a zero real wage gain. Zero wage gain. There is zero wage gain if you adjust for inflation. So the report didn't mention anything about that. And so what that would mean is your wage growth in real terms would be flat, yet your interest payments would continue to rise, i.e. your debt service payments would outpace your real wage growth, which would actually impact households even more. And I've already seen rising debt service payments that are rising beyond the pace of wage growth. And that's not only through that, but you can see that how that's starting to weigh on consumer spending. Is more of your disposable income is going to service unproductive debt. You're servicing more on the interest, so you have less to spend in the economy. And so, unfortunately, I understand, I'm empathetic to where home builders are coming from and to where mortgage professionals are coming. Being myself an agent, a realtor, this predicated on commissions. Of course, this is not good for the industry, but you have to look at it from what's best for the economy as a whole. And so Canada has their household debt to GDP is at 100%, which is the highest in the G20. I mean, you can't say that it's the lending has been too restrictive, because all you've done is let households borrow money for the last 2 decades, i.e. you're now stuck with record high household indebtedness and record high home prices. And you're stuck now because you're trying to raise interest rates and you can't get to 2% without everything starting to crumble underneath that. And so policymakers have to make a decision. It's either you push on with the status quo. I think it'll be akin to pushing on a string. You'll basically encourage households to continue to borrow, and you'll continue to rely on sort of asset inflation. You'll continue to try to spur home price growth, or at least keep the prices stabilized, and try to keep the wealth effect somewhat elevated. And the household indebtedness will stay where it's at, and that will be, in the long run, unproductive, because as households become as indebted as they are, there's really just not as much capacity to then spend and to grow in the economy. And so, this debt burden basically just weighs down on society, and you'll just be stuck with this sort of muted growth, potentially for decades, similar to Japan. Or you implement stress tests, you push interest rates up, and what this will do is unfortunately, there's no way both situations, in my opinion, are painful. You have stagnant growth for the next, decade or two, or you deleverage the household sector, you pay down their debts, similar to the United States households did in 2008, as you can see through the debt to disposable income, the difference between Canada and the US. You pay down that debt, and then it gives you room to grow again. The consumer can, you're going to have, unfortunately, people will go bankrupt, some people that are over leveraged, but you need this cleanse to sort of hit reset on the economy. It's similar to all these central banks doing quantitative easing and just pumping funny money into the system, keeping interest rates suppressed for 10 years. What you've done, you create all these zombie companies, these companies that shouldn't be around, but they're around because it's just easy. They just keep borrowing money, more and more money, and they don't even have sufficient revenues to actually service the debt, but they're able to continue borrowing more debt just to stay alive. So it's you have these zombie companies, and I think it's similar. You have these zombie households that really they should be bankrupt. They should, but they just you just keep borrowing more money. You keep refinancing your home, and it's just this sort of this debt Ponzi that basically continues to build. So, but policymakers, you can't have there's no free lunch. It's either way you're going to go through a painful situation. And so I think the mortgage professionals or whatever, or the home builders, they might have a different perspective. Say let's just keep the status quo. But I think the issue that I take to heart is that they're trying to frame it as the poor millennials, we need to help them get in and afford a home. But the only way to get like true affordability is for the home prices to come down, and that's natural for home prices to be cyclical. For them to go up and down is natural, and so trying to suppress the natural cyclicality of home prices is not healthy. And to just say, oh well, we'll give first-time buyers more money, or let's make it, not a 25-year amortization for first-time buyers, let's give them 30 years. Well, now all you're doing is arming, first-time millennial buyers with the ability to leverage themselves even more. So it's basically like, if 2 people or 3 people are competing for a condo, it's like, well, whoever leverages themselves more, whoever pays the higher price or takes on the more leverage will get the condo unit. It's like, that's not how you get affordability. So I take issue with that, and I take issue with, I understand that the stress test is quite punitive. It's not the easy credit that we're used to, but again, to say that borrowing, to suggest that these policies haven't been in favor of the real estate market for nearly 2 decades, through various CMHC programs, insuring mortgages. In 2009, there was bailouts that amounted to about $114 billion, $69 billion through a program called the IMPP, which basically helped securitize a lot of the bad mortgages off the bank's books. CMHC basically purchased them off the balance sheets of these banks. That is, like, nobody ever wants to talk about that. I mean, in 2007, you had CMHC insuring zero-down mortgages with 40-year amortizations, fully backed by the Canadian taxpayer. So nobody ever wants to talk about, like, the stimulus that these markets have been given over the last 2 decades, which has brought us to where we are today. And now everybody's crying foul that we're removing that punch bowl in the form of stress tests and tighter CMHC insurance regulations, etc. So that's my viewpoint. I'm sure it probably doesn't sit well with the industry, and I can certainly empathize where they're coming from. But I think from a long-term economic growth fundamentals, like where will we be better off as a society in the next 10 so years from now? I think it's by taking the medicine today and not trying to prolong this thing any further. So that's all I got for this week. Hope that helped. Otherwise, see you next week.